Okay, we now move to the understanding the securitization of subprime mortgage credit. So the topic talks about understanding the subprime market, and there are several frictions between market participants that are discussed, like mortgage or originator, arranger, rating agency, asset manager, investor. What we need to understand here is the information problem, that is moral hazard and adverse selection for each friction. Characteristic of subprime mortgage, like loan terms, performance and subordination are also important that we should look at here. And the subprime mortgage securitization, the friction in the subprime mortgage and the process of rating subprime mortgage security is something that we should know here. So I start with the securitization process. The subprime securitization process involves several different parties, beginning with the borrower, and the borrower needs uh, the ho- the home. So he is the initiating point of the whole process. The borrower is also known as the mortgager who applies for the mortgage, uh, and conditional on due diligence on the lender, a loan is given to him, and the thing that he purchases or his own is then residing as a collateral. So borrower range in quality from prime, which is strong, to alternate A, ALTA, that's borrower with good credit but aggressive underwriting standard, to subprime borrower, or borrower with poor credit history. Lending sell a significant portion of their loan to third party special purpose vehicle. So all lenders sell a significant portion of their loan to third purpose vehicle and receive a cash in return. Prime loans that meet confirmation standard are sold to government sponsored enterprises. The remaining loans are increasingly being sold and taken off the originator balance sheet. Approximately 70% of newly original subprime mortgages are securitized in 2005 and 2006. Now let's look at some of the frictions in the mortgage securitization. So the two parties who don't have the same information, which is usually the case, a subprime uh, are the suboptimal outcome results. So the two broad classes of information problems we should look here is the moral hazard and adverse selection. Moral hazard denotes the action one party may take to determinant of the other. A classical example is the shareholder-manager relationship, where the manager may use his position for personal gain rather than the benefit of the shareholder to whom they own a fiduciary duty. On the other hand, adverse selection is when one party possesses important hidden information. For example, a person driving ability is a private knowledge, and a potential buyer of auto insurance will have incentive to represent themselves as good driver even if they are not. Mechanisms are desired to minimize these information problem, such as board oversight for the manager and examination of driving record for those seeking insurance. Now there are seven friction, and we are going to look at each of them. And the first friction is mortgager and originator. The typically subprime borrower is typically financially unsophisticated. As a result, the borrower may not select the best borrowing alternative for themselves. In fact, the borrower may not even be aware of the financial option available. On the other hand, the lender may steer the borrower to produce to products that are not suitable. So that's between mortgager and originator. Now, as the name suggests, originator is the point of origin here, and mortgager is the person who goes and want to buy the loan. Then we have originator and arranger. The arranger or the issuer purchases the loan from the originator for the purpose of resale to securitize product. The arranger will perform due diligence but still operates an information disadvantage to the originator. That is, originator has superior knowledge about the borrower, and this is an adverse selection problem. In addition, the originator may falsify or stretch bounds of application, resulting in larger optimal lending, which is called predatory lending or predatory borrowing. Then we have arranger and third parties. The arranger of the pool of mortgage will possess better information about the borrower than third party, including rating agencies, asset manager, and warehouse lender. The adverse selection problem gives the arranger the opportunity to retain higher quality mortgage and securitize the lower quality. Lower quality mortgage are also known as lemons. The warehouse lender typically holds and finances underlying purchases. As a precaution, the warehouse will fund less than 100% of your estimated collateral value, forcing the arranger to retain an equity position on its balance sheet. The asset portfolio manager purchases the asset for the pool from the arranger, and once again the arranger has superior information about credit worthiness of mortgage pool. To minimize the potential adverse selection process, the asset manager must do adequate due diligence and use reputable arrangers and force credit enhancement for the arrangers. Similarly, the rating agencies that determine the amount of credit necessary to achieve desired credit rating. Thus, the rating agency is dependent on the information provided by the arranger. Typically, the due diligence on the arranger and the originator of the uh, duplicate the due diligence on the arranger and originator is rushed. Then we have the servicer and mortgager. The servicer role is to manage the cash flow from the pool and follow up delinquencies and foreclosures. A conflict of interest arises from delinquent loans. The home borrower in financial difficulties does not have the incentive to upkeep tax payments, insurance, or maintenance on the property. Escrowed funds can minimize the problem, but ultimately, efficient foreclosure must comply with federal regulation. Then we have the servicer and third parties. The servicer faces a problem of moral hazard because their lack of effort can impact the asset manager and credit rating agency without directly affecting their own cash flow distribution. In delinquency, the servicer is responsible for the property taxes and insurance premium. These funds are reimbursable up to foreclosure, so there is temptation to exaggerate the fees and expenses, particularly with higher recovery rates. Then we have also the servicer who has an incentive to keep the problem loan on his book by modifying loan terms rather than foreclosure, which is the preferred option for an investor. Since most of the costs are unrecoverable, like escrow analysis, payment setup, the property needs to be active to generate any additional fund for the servicer. It is apparent that the quality of servicer can directly impact the cash flow of the pool, which in turn affect the credit rating. Change in credit rating reflect poorly on the agency. Therefore, credit rating agencies must be doing due diligence in analyzing the servicer as an underlying collateral. Then we have the asset manager and investor. The investor relies on the asset manager expert to identify and analyze the potential investment. It is difficult for investor to comprehend the investment strategy, and the investor will not be able to observe the management team. Same moral hazard problem as shareholder manager. Investment manager mandates and proper benchmarking can mitigate these distortions. Then we have investor and credit rating agency. The rating agency are compensated by arranger, not the end user, who are the investor. To the extent that rating agencies are beholden to the fee of the arranger, a conflict of interest arises. It is very difficult to judge the accuracy of model, particularly with complex product and rapid financial innovation. So five of these factors are direct contribution to the recent subprime crisis. First, the complexity of products and the naive nature of the borrower led to inappropriate loans. Second, manager sought the additional lead from structured model product without fully accepting the associated risk. Third, problem became more expensive as underperforming managers made similar investment in due diligence on arranger or originator. Fourth is that the asset manager reduced that oversight. It is natural that arranger will follow suit. This left the credit rating agencies as the last line of defense, but they operated significant informational disadvantage. Finally, the assigned rating were hopefully misguided. If you look at all these frictions, they start with mortgager to originator to arranger to third parties to servicer to third parties, then to asset manager, and then to investor. So the whole chain of mortgage created for another investor is a little tricky here. Now we need to understand the characteristic of a subprime mortgage market. The subprime borrower has a history of either default or strong indication of possible future default. Past incidents include a 30 or 60-day delinquency, judgment, foreclosure, repossession, charge of bankruptcy filing. The low FICO score 660 or below or a high debt to service ratio of 50% are more likely indicator of future default. The vast majority of subprime loan are adjustable rate mortgage. These loans offer a teaser rate for a short period of time and then adjust each year relative to the floating rate of index, usually LIBOR. The 2 and 3 year teaser are called 2 by 28 and 3 by 27 hybrid terms, denoting the fixed and the floating terms. Now, since the majority of the term of the mortgage is floating, the borrower is bearing the interest rate in contrast to traditional fixed income rate where the lender bears the interest rate risk. The performance of subprime pool indicates default and foreclosure way above the historical level. As a reference, the author, whoever makes any analysis, should analyze the new century pool originating in May 2006, an estimate of 23% cumulative default rated through August 2007. So let's understand the process of securitization for the subprime mortgage loans. Securitization pool incorporates structure to provide protection to investor from losses in collateral including subordination, excess spread, shifting interest, performance triggers and interest rate swap. Subordination involves creating tranches of different priority level. Losses are applied first to the most subordinated tranches, which is equity tranches. The equity tranches usually created from over collateralization, that is excess of the face value. If the losses exceed the size of this tranche, the losses will reach the next highest subordination name called the mezzanine. Credit rating on mezzanine debt triple E vary from double A to B. In this fashion, the most senior tranche is protected by all junior tranches and offer the lowest return. Mortgage pool are typically considered so that the weighted average coupon, which is the less servicing, less hedging, other expense, exceed the weighted average payout. The difference is called the excess spread, which is paid to the equity tranche investor when available. The excess spread protects all tranches. Under shifting interest, the senior investor receives all principal in the pool, while the mezzanine receives only the interest. The senior bondholder may receive the principal for the same period of time, lockout, or until a cutoff ratio is reached. Performance triggers denote that the release of over collateralization, which is applied from the bottom of the capital structure. Since the first few years pool is fixed, the pool faces interest rates as protection. Interest rate swaps are used, where the pool will pay fixed and receive a floating rate. Now let's understand the credit rating process. A credit rating is defined as an opinion on the creditworthiness of specific bond issue. We should note that the assigned rating is specific to the security and in no way reflection of the originator. The rating represents an unconditional view of the rating agency as they are through the cycle. The rating process involves two steps: estimating the loss distribution and simulating the cash flow. Once the estimates are obtained, the agency indicates the level of credit enhancement necessary to achieve the desired rating. If the projected rating is too low, the originator can provide additional enhancement to raise the rating. Now let's look at the implication of credit rating on the emergence of subprime related mortgage-backed securities. Assigning credit rating for securitized assets presents additional challenges. Credit rating for subprime securities or more generally asset-backed securities differ from corporate rating in several important ways. First, corporate bond rating are based on firm-specific characteristic of issuer, and ABS is a claim on a portfolio. Hence, systematic risk and a degree of correlation between assets is important on the portfolio. Hence, the former ABS represents claims on static pool and cannot infuse additional capital or restructure via as a corporation can. There are more flexibilities to a corporation to play around with things and restructure and can still do away with the total default or non-payment. So the forecast of ABS incorporates future economic conditions since the cash flow is tied up with macroeconomic environment. Finally, while corporates and ABS with same rating may indicate different level of default probability, ABS will exhibit much wider variation in the losses, which is quite interesting because a AAA could be a mortgage, it could be a sovereign, it could be a corporate, but the default probability attached with all of them would be different. But if you have something that you have to buy in AAA, and then you can choose any of them: AAA, which is a sovereign, or AAA, which is a corporate bond, or AAA, which is a mortgage-backed security, and everything will have a different default probability. But ABS will exhibit most widest variation in the losses. Now we look at the relationship between credit rating cycle and the housing cycle. The goal of the rating is to rate through the cycle, meaning there should not be excessive upgrades or downgrades if the housing market heats up or slows down. A problem may arise where agencies stay AAA rated during a boom period. As the housing market slows down, the probability default increases and the security has to migrate to AA plus, even though the agency has not made a public announcement. The problem is further exacerbated if new deals are based on credit enhancement from AAA rated in the boom period. If the economic condition change, it is expected to see some upgrades or downgrades in the mortgage-backed security. However, the effect may amplify up and down market. For example, a downgrade trended market, additionally enhancement are needed to maintain the highest rating. This crowds out the credit available for lower rated borrower. Now we move to the cash flow analysis of excess spread. In the rating process, it is necessary to simulate the cash flow of the structure to forecast the degree of excess spread for credit enhancement. As you can imagine, the forecasts are complex and depend on several interrelated factors like credit enhancement, timing of loss, prepayment rate, interest rate, trigger event, weighted average loan rate, and prepayment penalties, pre-funding accounts, and hedging instrument. The more important factors are like the credit enhancement. Let's look at them one by one. So first, the credit enhancement identifies the amount of collateral that can be impaired before the trend suffer an economic loss. The timing of loss is also important. As loss accumulates, less excess spread will be available. A more conservative approach would front load the losses. Prepayment will directly impact the excess spread. Prepayment may be voluntary, refinance sales, or involuntary, like default to prepayment assumption directly impacts the cash managers. Prepayment typically follows CPR, conditional prepayment rate convention. However, it is important to know that hybrids will have higher predicted defaults on or about the reset date due to the sudden changes in the rates and the subprime borrower. A more conservative view would accelerate prepayment, reducing further interest collection. Finally, path of interest rate introduces uncertainty into the projected cash flow. Interest rate determines the adjustment, that is cash flows, influence the refinancing. Now we move on to the implication of subprime mortgage meltdown on the management of portfolio. Currently, the rating agencies collectively monitor approximately 10,000 mortgage pool. It would be impractical to monitor cash pool on monthly basis in detail. It is current practice to annually review each individual pool. An important performance measure used during this review process is loss coverage ratio, which is defined as current credit enhancement for tranche divided by estimated unrealized losses. So on the numerator we have current credit enhancement for the tranche, and on the down we have estimated unrealized losses, so losses that are not realized. An example of credit enhancement is excess spread. If LCR is breached, falls below an acceptable, full review is warranted. Now the last topic here is predatory lending and borrowing. So predatory lending and borrow is results in borrower becoming worse off after taking loan than before. This happens because the rates are deceptively high, the appraisal are inflated, allowing the borrower to extract equity and then cannot refinance, and prepayment penalties are extreme, steering borrower unnecessary to subprime products and similar rushes. Predatory lending may also include outright fraudulent activity in addition to deception. Now we have predatory borrowing. Predatory borrowing is misrepresentation in the mortgage application from borrower side. The temptation is driven by increasing house prices where the borrower feels that he cannot catch up with the housing prices. Therefore, lying on the mortgage application allows the borrower to buy the house with exception that continued appreciation will allow favorable refinancing. The fraud may be perpetrated by buyer alone or in concert with lawyer, brokers and appraiser. So that was the MBS. We'll look at some questions that you can see. Now question could be uh, like which of the following is not a friction in the subprime market, and uh, the mortgager and the arranger have no direct contact, so there is no friction. So whichever thing is not related are not friction. So all those who interact with each other will have friction, others will have not. So adverse selection. Now adverse selection uh, is a problem that comes into play. So the originator has better information about the quality of the borrower, so the arranger is subject to adverse selection problem. Then we have some points which could be asked as true or false, and some other questions on the predatory lending and predatory borrowing. So I'll quickly revise few points here. So most subprime are 2 by 28, 3 by 20 structures where fixed component is for 2 or 3 years, and hence remainder is 27/28, which is the variable which bears the majority of interest rate risk. Then predatory borrowing is when borrower misrepresents themselves to upgrade credit they otherwise would be denied. Predatory lending is providing credit that is welfare decreasing and should not be provided. Subordination, excess spread and shifting interest rate, protection for provide protection for senior tranches. Over also provide protection for senior tranches. Timing of losses impact excess spread. Prepayment can accelerate or de-accelerate the cash flow to the senior tranches. So that would be it for this session of the securitization of mortgage mortgage subprime mortgage. I hope this was helpful and see you in the next session.